Never's a long time.
Let me expand the conversation. We'll bring in Charles Schwab's Kevin Gordon. He's with us here at Post 9, and Truist Keith Lerner is joining us as well. It's great to see you both. It's a good segue, Keith, to go to you, because that is one of your principal picks, the small caps, which you upgraded.
That's right. Well, great to be with you. I've been listening to the conversation. I actually agree with a lot of it. I mean, we're still bullish on tech. We're still bullish on large caps longer term. But on the short term, the weight of the evidence in our work has shifted to be at least somewhere incrementally more positive for small caps. Let me just walk you through those factors, Scott. One, we all know they've underperformed by a lot. Even with this move up on Friday, over the last year, they've underperformed by about 10%. Over the last 3 years, about 40%. That's the most extreme divergence since around 2000. They're cheap. They've been cheap for a while. But one thing that's changed is the earnings. The earnings for the forward earning estimates for the sector have started to move up. That's tech, that's communications, that's financials, that's industrial. So it's broad-based. I think Dan mentioned already the one big beautiful bill is also, a positive as well. And then on top of that, you throw on the technical position is also improving. We have the index is in an uptrend. We had a breakout on Friday. Relative trends are improving as well. And then lastly, positioning. We've seen, if we look at something like the S&P 600 small cap ETF, you've seen the most extreme outflows on a 3-month basis that we've seen in the last decade. You put that all together, I don't want to be negative the space. Again, we upgraded it to neutral. We think there's potentially a trade that can last a couple of months as well, and that's why we upgraded our view.
I don't know, Kev, if there's a more polarizing positioning conversation to have in the market. Some people love that area of the market. Some people hate it, no matter if you're getting rate cuts or not.
Yeah, it's polarizing because you really had to segment small caps and put them in their own category in the post-pandemic world because even if you date it back to 2022, when you had the start of the new bull market for the S&P, a year after the beginning of that bull market, it was the first time ever that the Russell 2000 was actually lower in the first year of a bull for the S&P. So since then, it's been this really abnormal and unique cycle where the Russell hasn't been able to get back to its November 2021 high yet. Yet we've seemingly had multiple cycles in certain parts of the economy, whether it's manufacturing or whether it's housing. But you look at some of those areas in the U.S. economy, if it is manufacturing, if it is housing, they're still in a way stuck in their own recession. Maybe housing more so than manufacturing, but the Russell is going to be more tied to that part of the economy. Vice versa, large caps don't necessarily, need that kind of stimulus, whether it's via rate cuts, whether it's via fiscal, and that's really where we've been in the past 4 to 5 years. So it's polarizing in that sense. But I will say, and to some of the points that Keith was making, if you do take a fundamental or characteristic-based approach to an index like the Russell, you can find some good pockets of outperformance. It's just that index is so large, and there's a good chunk of companies that don't have any earnings, that are saddled with a lot of debt, that just don't do really well when the Fed funds rate is above 4% and when the 10-year is above 4%.
Speaking of Fed funds rate, you make the argument, you're kind of on the other side of Greenhaus and saying it's not a done deal. September. He says 100%. Yeah. Fed's cutting. Why don't you believe that?
I'm not on the opposite where I don't think they'll cut. I just think that the data set we need to wait for, whether it's the jobs report, whether it's CPI, PPI for this current month, that's going to be a pretty big determinant. Maybe not as much for September, but I think if we're going to talk about policy momentum now starting to shift back into easing or cutting mode, I'm not sure that the Fed wants to just do September and then call it quits. That would maybe call into question what the purpose is of just going in September. If it's to not go against the market, I get that because it's pretty, as Dan said, it's not necessarily consistent with history where they would just go against, more than 80% odds.
So let me ask you this then. Let's take it to the step 2 of that debate.
Yeah.
Does the market need a rate cut in September to continue to go higher or not?
I don't think so. You can base it off of history, and if you look at the times when, the Fed has reengaged in a cutting cycle after waiting more than 6 months, we have 7 of those instances in history. The range around the average, with the S&P 500 going up on average 16% in the 12 months after, there's a huge range around that. The best time being slightly more than 50%, the worst time being slightly more than 3%. And in that worst period, it was actually the recession that started in 1990. Short and shallow bear market, not a devastating recession, but still, the macro conditions matter a lot more in which they're cutting versus just does a cut mean it's a bullish outcome for the market.
Okay, what happens if they don't cut and the president fires Powell? Then what?
Well, I mean, from a legality standpoint, there's still a lot of questions as
no,
to
I don't even care about that.
The case. I think that volatility-wise, what we saw when there were news reports of that happening, where it was kind of that back to that early April moment, dollar down, yields up, stocks down. It was a short reaction because it was only a short time that news was in, that headline was in the news. But I would assume that would sort of be the instant knee-jerk reaction.
As the question, for the context of both questions, essentially, does the market need a rate cut? Because if Powell and company don't cut rates, you think the president's going to be happy?
Yeah.
Then he looks at the calendar and he's like, you know what? I might as well bounce this guy now.
Yeah.
And who cares what everybody else thinks? I'm just going to do what I want to do.
Sure.
He doesn't get it.
It's one thing to say you're fired. It's another thing for Powell to leave the building. And to Kevin's point, the Supreme Court went out of their way to sort of put a foot in the ground here and say maybe you can't fire him. So I'm not even positive if the president announced over Truth Social, you're fired.
Okay, does the market want to have that fight?
The point I was going to make, no, the market doesn't want to have that fight, of course. But the point I was going to make is it's not like waiting in the wings is howdy doody. The people being discussed to be Fed chair, if and when Jay Powell leaves, whether that's in September or that's in March or whatever, these are David Zervos, eminently qualified to be Fed chair. I don't want to single anyone out, although I guess I just did. Zervos.
Well, it was kind of teasing his appearance on our program today.
Closing bell shortly, folks. Tune in. But all the other people on the list totally qualified as well. Again, it's not like it's a list of unacceptable people, let's say. Every one of them, more or less, would be acceptable to the market. So, yes, the market doesn't want to the market doesn't want to have that fight. But again, it's not as if you're replacing him with some person that's going to come in and immediately cut 100 basis points irrespective of the data. So I think there's a little bit, that's a fun conversation to have. I'm not sure it matters that much.